This is part 3 of the Options Education series we're calling Mastering Options. Today we're going to be talking about straddles, strangles, and time spreads. So if you've watched the previous classes, then you know that I'm Jason Hitchings. I'm the CTO at CML. I started working with Ophir about 15 years ago at a company called LiveVol. And that's when I first started getting into options analytics and options trading. I was trained by some floor market makers that were the founders of the company. And I have been trading options ever since. One of my kind of first big goals at that company was to allow us to process 200,000 accurate option calculations per second. So I did deep dives into all the different models, all the binomial trees, and all that good stuff back in the day, and I've been trading options ever since. So this is the breakdown for today. We're just going to talk about long straddles and long strangles. Then we're going to get into short straddles and short strangles. We'll go pretty deep into long time spreads and kind of discuss different strategies for capturing upside movement of a stock over time. And then we'll touch briefly on short time spreads. And then I'll give a quick summary and I'll answer any questions that are still remaining. So before I go into the formal presentation, let me just kind of go through the standard disclaimers. It'll just take about a minute. This is not a solicitation to buy or sell any security ever. This is not advice. You should read the characteristics and risks of standardized options. The results here are provided for general information purposes as a convenience to the viewers. The materials are not a substitute for obtaining professional advice from a qualified person, firm, or corporation. Trading futures and options involves the risk of loss. Please consider carefully whether futures or options are appropriate to your financial situation. Only risk capital should be used when trading futures or options. Investors could lose more than their initial investment. Past results are not necessarily indicative of future results. The risk of loss in trading can be substantial. Carefully consider the inherent risks of such investment in light of your financial condition. Okay, so if you are in this part 3, then hopefully you have a pretty solid background in options trading or have watched the previous 2 classes. You can always go back and watch those. But yeah, you should have a good understanding of looking at an option montage, all the strikes and expirations, bid asks, and all of those things. You should know how long and short calls and puts work. You should be familiar with reading a stock P&L chart. That should be pretty familiar. We're going to use quite a few of them today. And you should additionally understand long and short call and put spreads and understand how the delta and implied volatility would affect all of these different types of positions. So far we've been talking about calls and call spreads, puts and put spreads in the classes so far. All of these are directional bets. In each case, we are hoping that the stock will move up for call or call spreads or down for put and put spreads. As we know, all of these positions have different deltas. An at-the-money option delta is close to 50. And as we know about delta, one of the important definitions of delta is how much does your position change in value, your option position, for a $1 change in the underlying price. So when we have an at-the-money call, we have about a 50 delta, and that tells us for that contract that if stock goes up $1, we expect to make about $50, about 50 cents per share. If we have an at-the-money put, that would have a negative delta, meaning if the stock goes down $1, we'd expect to make about 50 cents per share or $50 per contract, and vice versa. So this type of trading is you constantly have either positive or negative deltas. If you have a spread, then the total number of deltas you have is going to be less because you might have an at-the-money call that has a 50 delta, and you might sell an out-of-the-money call That out of the money call could have a 10 delta or a 30 delta, but let's just imagine it as a 25 delta. And you can actually add up the deltas in your position. And from those, you can say how your overall position is going to change, even if you have lots of options and lots of expirations, at least for the next dollar change in stock. So if you were long the 50 delta call and short the 25 delta call, well, then you're net long 25 deltas. That means if the stock goes up $1, that your position is probably going to change about 25 cents per share or $25 per contract. So that's fewer deltas than a naked option, but you're still, if you're long the calls, then you're still long deltas. And even if you sell spreads, you're still directionally trading. You're just hoping it doesn't go the wrong way. So this is this kind of gives you a sense of the way you can think about your portfolio, the way you can think about your deltas. You can either be long delta or short delta, and that you're making a directional bet on which direction the stock will or will not move, and that's going to directly affect your P&L. So the question becomes, what happens if you own both a call and a put? So the call deltas are going to be positive and the put deltas are going to be negative. And if those two are both at the money options, then they're probably going to both have about a 50 delta. One's going to be positive 50 delta, one's going to be negative 50 delta. What happens in that position? So if the stock goes up $1, your call is going to go up about 50 cents per share, and your put is going to go down about 50 cents per share. And so your overall position, you've made 50 cents in the call and you've lost 50 cents in the put. So there's been nothing that's happened in terms of the first change, the first dollar of change in the stock price. But if you bought a call and you bought a put, you spent money doing it. So when stock moves, the first dollar, you make nothing one way or the other, and it cost you money to put on this position, then what's the point? What have you accomplished? So this position right now is what we would call a delta neutral position. It means the deltas are roughly zero. That as of right now, you don't have a strong bias for the stock to go up or down in terms of how it's going to affect your P&L. But let's dive in a little deeper. So if you have the call and the put, as we mentioned, one's going to win, one's going to lose. So what's the point? So what do we know about calls? What's the most you can possibly win if you're long a call? Well, potentially you have unlimited upside, right? There's not really an upper limit to how far a stock can go up in value, and so therefore there's not an upper limit to how far the call can go up in value. Call is giving you the right to buy the stock at a lower price if the stock has gone up. So you can have potentially unlimited upside potential with the call. And how much is the most you can lose? Well, anytime you're long options, the most you can lose is the amount that you bought the option for. So you have a fixed downside and you have potentially unlimited upside. Here's a kind of little snapshot P&L chart. Stock movement is up to the right, down to the left. So it's flat. This is the break even. You're underwater. You've lost money up until you hit your strike price, and then you start making some money back. Eventually you get over the cost of the initial option, and then you start being in the positive territory. How about a put? Well, essentially the same thing. I mean, you can make money as the stock drops because you can sell it at a higher price up until the stock hits zero. So you have a lot of potential gain as the stock goes down. And the amount you can lose is still just the amount that you initially put into the position. So you have a fixed downside and a ton of potential as the stock moves downward. I kind of call that downside potential. Okay, so this is the put P&L chart. This is the call P&L chart. What happens if you combine these two? What does that look like? Okay, so here's our call, here's our put. What does this combined look like? Well, if we're buying both a call and we're buying a put, then we're buying two different options, and so that's going to cost more than buying an individual option. And so we're going to represent that by showing a higher break-even point on our little combined P&L chart. So whatever else happens, we're going to have to make money, we're going to have to recover the value of two different options instead of just one option. So we know we're going to have to get more out of these one way or another. So I'm showing the call in green, I'm showing the put in red. And when you combine them, kind of overlay these on top of each other, you can see that the put's still making money as the stock goes down, the call's making money as the stock goes up. What are these flat spaces? So this is the area for the call below the strike price where you've hit your maximum loss. But there's no change. There's no change in value as stock goes down an extra dollar. Like if you own a 50 strike call, and there's no difference for you if the stock's at 40 or if the stock's at 30. So these flat lines, you've already hit your max loss. And same with the put if the stock's too high. So when we render these on the chart, when you combine them, you really don't need to see them anymore, especially here because they're getting canceled out because your call is not going down in value anymore, but your put is going up in value. So the call is not affecting the position, but the put is. We can actually just zap those out of the chart. And this is what we have in terms of our combined call and put P&L chart. We call it a straddle. This line represents the at the money price or the strike price. This would be, they both would have the same strike price, wherever the stock price is. And you can make money if the stock goes down or up in theory. But how do you do that if it's delta neutral to start? Well, we can see it with a small movement to the right or to the left. We're still in this negative territory. We still haven't gone far enough in either direction in order to make money with the call or the put. But if the stock moves substantially, then eventually the call can start to become valuable enough that it's worth more than both the original call and the put cost you. And same if the stock moves down far enough. Eventually the put can be worth enough that it covers the entire position, and then you can start making some additional money. So what does that tell us about the delta? Before, the call and the put were both 50 delta. But if the stock price actually can result in our position increasing in value, then they can't both be 50 delta forever, right? And if we think back to some previous classes, what happens to an option that's in the money? If you have a call that's $10 in the money versus a call that's $10 out of the money, which one's going to have a higher delta? Well, one definition of delta is the chance that an option will finish in the money. And so it stands to reason, if you're buying an option that's already in the money, then the chances have to be higher of it finishing in the money. And so therefore, an option that is in the money is going to have a larger absolute delta. So a call is going to have a larger positive delta, and an in the money put is going to have a larger negative delta. The further in the money your option gets, the more the call will start to act like stock, just pure stock, where every time the stock goes up $1, your delta is going to go higher and higher and higher. It's going to go from 50 to 60 to 70 to 80 to 90 to 99. At that point, when the stock goes up $1, your position is going to go up 99 cents. So it's going to mimic as if you owned the stock outright. And same in reverse. If you own a 50 strike put, as stock goes from 50 to 40 to 30 to 20, it's going to be a lot like you own short stock. Every time the stock goes down $1, you're going to make 99 cents in your options position. So we can see that initially you're starting off with a delta neutral position. But as the stock starts to go up, the call delta is increasing and the put delta is decreasing. And all of a sudden you have a long delta position. So once the stock starts going up a little bit, you are no longer unbiased about what direction you want the stock to move. You are now have a strong incentive for the stock to continue moving up, because that's going to be the quickest path for you to get into this profitability zone. And same with the stock starts moving down. Your negative deltas of this position are going to increase. The call delta is going to move towards 0. The put delta is going to move towards negative 100. And the further that goes, the more incentive you're going to have. There's a term for how delta changes over time, and that term is called gamma. And I'm just going to mention it right now, that gamma will help tell you how much your position is going to act like stock as it changes, how much the delta is going to change over time. And then we'll touch on that more in the 4th options class. Okay, so let's look at a real example. Let's look at an at-the-money straddle. And then how am I going to decide what company to look like? I could just pick a ticker at random that I know. But let's use TradeMachine to find something more interesting. And so I'm going to pick a time range of the last few months, because I think that's more representative. I'm going to look at the last 3 or 4 months of data, because the market's been in a different paradigm than it was for the couple of years before that. So I'm going to look at that pretty recent stock history. I'm going to look at options that are going to be expiring about 14 days out. And again, we can never, with TradeMachine, we can't invent options that don't exist. So it's going to look for the options that are closest to 14 days out. Could be 10 days, it could be 23 days. It's going to look as close as it can. I click on my portfolio view. I've created a portfolio of the NASDAQ 100 stocks. I'm going to click a straddle. And I'm going to say never trade earnings, because I don't want a couple big earning moves to distort how the entire position looks as I'm looking at individual tickers. So I'm going to say never trade earnings. Additionally, I'm going to double check my deltas. If you click the little settings gear on the top right, it's going to open this backtest settings window. And if you're testing multiple tickers, then it's the center delta that is going to determine the deltas in your position. So the first leg is going to be the top of these two, and the second leg is going to be the bottom. So this will be the call delta, and this will be the put delta in the straddle. Okay, so I let those run, and it starts giving me results. It takes a few minutes to do 100 back tests for these different straddles, and then I just start looking through the results. Then I kind of pick out some ones that look pretty attractive. So it's MNST, ADSK, PayPal. So we see these different things, and I like the win rates, and this has a high, percentage return ROI. So I'm going to go ahead and pick this as my example, the MNST. Okay, so I pull up an option montage. I was doing this around the 6th or so, and this 22nd of April was about 18 days out at the time. Maybe that makes it on the 4th. So here's our montage. We have calls over here, and we wanted to do a 50 delta straddle. We can see these deltas, as we talked about, the in-the-money deltas are much higher. They go towards 50 delta as you go to at the money, and then they go lower and lower as you get further and further out of the money, and then vice versa. The in-the-money puts have a higher delta and they go lower. We want something around 50 delta, so we have 53 and 47, 53 and 47 on this side, so 82 and 83 are both pretty much equally close to the at the monies, according to the delta picture. So I'm just going to go ahead and pick the 82. And I'm just going to do a single contract just to, to make it real. And just single contracts are a little easier to see the P&Ls on. And the markets were 260 at 3 and 220 at 275, and I got filled at 290 at 260. So my overall position is costing me $550 to hold this straddle. So we know that this is what the P&L chart's going to look like. This is where our put's making money. This is where our call is making money. So what's our break even? So it's costing us $5.50 per share to have this position. And either the call is going to make money or the put's going to make money, but they're not both going to make money. And both have the right to either buy or sell stock at $82. And so we're going to need the stock to go up or down $5.50 to break even. So we've drawn this line here, and it's about $5.50 down from 82, or about $5.50 up from 82. So that's our break even, where we're going to actually start making some money. Anything in this zone, we've lost some amount of money. Worst case scenario is 82, because the call and the put are both worth 0. Okay, so now we can just map this out. Every time the stock goes up $1, we make $100 in our position on the call, and vice versa with the put, in terms of where we land at expiration. So this is a P&L chart of what the position's worth at expiration. So we can see if it's at 82, we hit our worst case scenario, which is we lose the whole value of both options. And as we go up around 88.50, we kind of crest through or 87.50, we crest through our break even, and then we make $50 at 88. If the stock goes all the way up to 100, we've made $1,250. And same in reverse, if it goes all the way down to $64, we've made $1,250 on the put. And that's how this P&L chart's going to look for this example. Okay, so we can make money if the stock goes up or down, because the deltas actually change. It starts delta neutral, but as the stock goes up, we start being long deltas, and as the stock moves down, we start becoming short deltas. And so we can make money, because delta is not static. Delta tells you how much your position changes right now for this current stock price, but those deltas change over time. You can describe the change with something called gamma that we'll talk about later. Okay, so is that the only way to make money with the straddle? Is for the stock to move a lot in either direction? What happens if the implied volatility of the options goes up? Does having options with higher implied volatility, does that make them more expensive or less expensive? So before we looked at some distributions, and we said, okay, so if there's some theoretical stock, and that's the trading price of the stock, well, when the volatility assumption is low, then the stock is expected to kind of stay in a closer range. And when the stock volatility is high, or the expected volatility is high, then the market's expecting a wider range of movement. If you need the stock to move $5.50, then a wider range of movement means more chances to make profit, because there's more chances that the stock's going to move at least $5.50. So here's with the low volatility assumption. There's these kind of little pockets of profitability, and this is with the higher volatility assumption. We have these bigger pockets of profitability. So if the market's assumption about implied volatility go up, then this is the future the market sees. They see more chance of profit and more value in the options. And that can just be the potential of movement. It doesn't have to be any actual movement. So if you see a big hurricane approaching the East Coast, all of a sudden you might see the options in Home Depot start to get very expensive, because there's a chance of a big hurricane that's going to do a lot of damage to property, and there's going to be a lot of people that are going to local hardware stores and buying things to fix up their home, and it could mean a lot of sales for those companies. It doesn't mean that anything's actually going to happen, and it might just be as people are watching the weather and they see a tropical storm forming off the East Coast somewhere. Those options can start to get more expensive. That's the market looking at the potential for movement in the future. It doesn't mean that there actually is movement. Home Depot might not change much in value, even if the options start changing in value. So when we look at this particular position, we see that the implied volatility is around 36. What happens if if there's a rumor of some kind of deal that MNST might get bought out or something else, and the options start getting expensive? Well, let's plug it in. Let's say, okay, right now we're starting at a 36 implied volatility for these options. The market is pricing into these options a annualized movement of this stock of around 36%. Now, it only has 14 days to move that much. So they're not saying it's going to move 36% in 14 days. They're saying it's going to move at a clip of roughly 36% per year over the course of the next 14 days. So when we plug this into an options calculator and we plug in our volatility assumptions and the days to expiration and the exercise price, it tells us what it thinks those call and put options are worth, and they line up well. So it's saying that the midpoint of this call is around $2.80, and that's right smack in the middle. And the put is pretty close too. Really, it's like 30 cents up and down. So the options calculator is agreeing with the Thinkorswim montage very closely. So what happens if we go from a volatility assumption of 36 and we crank that up to 50? Well, if you owned both of these options, then you'd be paying $5.23 if you could get them at the midpoint. If all of a sudden the market thinks that the stock might move at 50% per year, that position is now worth $7.27, even if nothing has changed. So in that sense, you own volatility, your long vol, because as the volatility assumptions increase, the value of your position can go up. And in this case, your position would increase about 39% in value from that move from 36 to 50 vol. So you might have heard someone say that trading options is trading vol. And it's very true. Whether you're long or you're short, every option is tied to the volatility. That's how the options are priced. So when you have this straddle, you can make money either through real movement, real volatility of the stock, hoping it goes up more than 550 or down more than 550, or by an assumption of future movement. If that increases faster than the time value of our position decreases. These are long options. And so we know that once you're at expiration, the remaining time value in the option is going to be zero. Any value that's left is the intrinsic value at that point. If you have the right to buy or sell this MSTN stock at $82 and it's the it's expiration day and it's still at $82, those have no option, no value. There is no premium, no time value left in those options. So time when you're long options is always working against you. But if the volatility assumption increases, then the options can still go up in value. Now we touched on this before, but we know that as the stock goes up or down in value, that we're actually going to be not exactly delta neutral. We're going to be slightly long or slightly short deltas. Oftentimes, if you're trading a stock, if you're trading the SPY, you might have all the strikes you want and be able to get very close to at the money, but it's frequently the case that there might be a stock that's trading at $11.10, and the choices for which strikes are the 10 strike or the 1250 strike. So if you wanted to buy a straddle, you're going to have to choose either the 10 strike or the 1250 strike. And so if you choose the 10 strike, well, then the call is going to be a little bit in the money and the put's going to be a little bit out of the money. And you're going to be leaning a little bit long. So even though you're buying a straddle, your position is going to have positive deltas, and the way to make money for you is going to be for the stock to go up. And the same is true if you buy a straddle that's a little above the stock price, then the puts are going to be a little bit in the money, and you're going to be leaning a little short because the best way for you to make money is for the stock to go down. So that's something to think about. But there would be another choice if you wanted to benefit from the volatility of the stock and you didn't want to lean short or you didn't want to lean long. You don't have to have the call and the put be on the same strike. In that scenario, if the stock was at 11.20, you could buy a put at the 10 strike and you could buy a call at the 12.50 strike. And both of those options would have lower deltas, but they'd be much closer to canceling out. Your put might be 40 delta and your call might be 37 delta or something, but you'd be much closer to delta neutral. So let's look at an example of that with this stock that we're following. So instead of buying both the call and the put at $82, we're going to buy the call at 86 and we're going to buy the put at 78. So our options are going to be about $4 out of the money, and they're going to be fairly balanced. It's saying that the delta of the 86 strike is around 31 and this delta is around 25, but those are pretty close. And we could choose to have a less balanced. We could have the 79 or something if we wanted to balance this out more, but we're just going to choose options that are $4 away from at the money, and that's going to get us pretty close to a delta neutral position. Okay, so we see that the 86 call is worth around $1.25. The 78 puts worth around 113. So we can combine those together to see what our total cost of this position looks like, and it's around $2.38. And if you recall, that's less than the two at the money options were. As we know, at the money options will always have the most time value because they're going to be the most sensitive to movement of the stock or the underlying. Because they're the most sensitive, they can capture the widest range of possibilities, and that's what options are all about. So as you go further out of the money, there are going to be less valuable options. Okay, so we have this position. When they're not both the same strike, we call it, if they're both out of the money, we call this position a strangle. Okay, so now that we have a call at 86 and a put at 78, what's the worst case scenario? Well, we own options, and it's very possible that neither one of these ends up in the money. For the call to be in the money, the stock has to go above 86, but for the put to be in the money, the stock needs to go down below 78. Because again, if stock's at $80, having the right to buy it at 86 is like having the right to buy a $25,000 car at $30,000. That has no value. So in this range between 78 and 86, these options will have no value, in which case we're going to lose the entire amount we invested. In terms of the break even, well, we're going to need to make either $2.38 on the call or $2.38 on the put. To do that, stock's going to have to go $2.38 above 86 for the call to have that value, or it's going to have to go $2.38 below 78 for the put to have that value. So the break-evens are those two price points. And the best case scenario is that the stock either goes to 0 or the stock goes to 500. In theory, you have more upside with the call, but practically speaking, you have a lot of good potential either to the upside or to the downside if stock moves a lot. So we see our worst case scenario is we lose the $238 per straddle. We need to be $2.38 above or below the call or the put. And we have essentially unlimited upside, and we have a ton of downside potential as well. Okay, so let's chart this out. Okay, so 78 to 86, that's the range where we get no value from either option. So we kind of know we're going to have some worst case scenarios down here. In order to break even, we're going to need to be $2.38 below 78 or $2.38 above 86. So we can actually just draw those little hash marks in here. And we know that's slope because we're going to make more money as it goes this way or more money as it goes that way. And that's all of those worst case scenarios. We have a wider range of worst case scenarios, but the total cost of our initial position is less. And so now we can just fill in the lines. We can just draw the lines out for the rest of it. We see this is the worst case over a pretty wide range here. As the stock starts going further down, we start making money. As it goes further up, we start making money as well. And if it goes as high as 100, we'd make $1,162 on the position. So let's look at these two. So the range on this, to chart this straddle, we had to chart values from 550 to 250 for the same stock prices. For the strangle, we really is about 250-ish up to about 180 or something. So this straddle is covering a wider range of possibilities, both a wider range of potential downside and a wider range of upside. Our worst case scenario for the straddle was down $550. The worst case for the strangle was something like 238. That doesn't necessarily mean that a strangle is always better, however, because when you look at your break even, we can see that the straddle's breaking even around 77, whereas the strangle is breaking even closer to 75, below 76 somewhere. And same on the upside. The break evens for the straddle are actually a little closer in. So you can actually, the chance of making any money is actually a little better on the straddle. And if the stock gets, say, up to 90, you've made some more money. You're out here at around 250 or something like that, and here you're down closer to 170 or 175. So the straddle is a higher cost position. The break-evens are closer in, and there's higher potential profits. The strangle has a lower initial cost. It's a little harder to make money to reach your break-even, and if you get to a profitable zone, you're still going to make a little bit less than you made with the straddle. Okay, so those were long straddles and strangles. What does the reverse look like? Okay, so for a long straddle or strangle, in order to become profitable, you need the stock to move substantially. We also know that they're going to benefit from increased implied volatility. Implied volatility is essentially how expensive the options are. If you own options and they get more expensive, then you can sell them back at a profit, even if you don't wait for expiration. So short straddles and strangles are the opposite. What you're hoping for is the stock to not move very much. And for the implied volatility, if you want to exit early at a profit, then you can exit early with a profit if the implied volatility decreases. If you hold this all the way to expiration, then the implied volatility doesn't matter, because the future movement of the stock over the course of the next year has no bearing on the position if you have 5 minutes left to make your decision about whether to buy or sell the stock. So again, the implied volatility tells you how expensive, how much time value is in the option, how much premium is in the option. Has no bearing on the intrinsic value. So because we want high volatility and high implied volatility on the strangles and straddles, you can call this like being long vol or buying vol. And the short straddles and strangles you can consider to be short vol. Okay, so here is a picture, the P&L chart of being short a straddle. We see that our best case scenario now is that the stock hasn't moved at all, and we're going to make our maximum profit of $550. We start losing some money as the stock goes way down or it goes way up. And if we're lucky, the stock might just zigzag back and forth. The stock can actually move quite a bit if it doesn't keep moving in the same direction. So if the stock bounces between 80 and 84, 80 and 84, and it's moving, a substantial amount, $3, $4 every single day, but it doesn't go anywhere. It's just like a ping pong ball bouncing back and forth between these two values. That's fine for us because it's going to still land it nicely in this high profitability zone for us. But even if there's small movements, if they go consistently in one direction or the other, then we're going to no longer be profitable. And the downside is essentially infinite. There is something, if you want to trade a short straddle, there are ways to do it without infinite downside. And we're going to talk about that next in the fourth options class in this series. And you can actually buy some protection out here. You can change this position from a straddle into something called a butterfly. And we'll talk about that next time. Here's what our short strangle looks like. You can see that your maximum profitability is over a wider range, but your maximum profit is much lower. It's at $238 now. If it goes far enough, you'll start losing some money. And there's still essentially unlimited downside, and an unlimited downside either as the stock goes up or it goes down. It can cost you an unlimited amount of money essentially. But the chance of it costing you anything are lower because it has to move further before you're outside of your maximum profitability zone. Okay, so we're gonna move on to our next type of position. Okay, so let's just talk through a scenario. And let's imagine for a moment that you're expecting steady growth in a stock's price over the course of the next 6 months, somewhere between 10 and 20%. And you want to benefit from that increase in price. What are the strategies we can employ? Like, what do we know about options so far? What does your own trading experience tell you about ways that we could do this? Well, the simplest thing to do would just simply be to buy some stock, right? So if we buy stock, and like we'll just stick with MNST as our example, it's at 82 today. So if it goes up 10%, it's going to be at 90.20. And if it goes up 20%, it's going to be at 98.40. So if we just buy the stock outright and we're not on margin, then our expected return is 10 to 20%. And that's pretty good. What else could we do? We could also just buy a call, right? Now, buying a call that expires out 6 months is going to be pretty expensive. It's going to have a lot of time value because there's a lot of time for the stock to move. And it's not always clear whether you want to buy the 50 delta or the 20 delta or the 30 delta. But in this case, we'll say we're going to buy an option that's a little bit out of the money because it's a little cheaper than buying the 50 delta call. And then how does that do? If we buy the 40 delta call and we're right about our assumption and stock lands between 90.20 and 98.40 6 months out, what does that look like? So what does that cost us right now? So we look to our montage, we go out to the 16th of September, we look at the 90 strike, and we say, okay, the bid is at 360, the ask is at 390. So our midpoint is going to be around 375. It's going to cost us $3.75 to enter into this position. And how do we do if we end up in that kind of 90 to 98 range? So this says 10 to 30. This is actually 10 to 20%. So if we are buying the September call at 375, where do we end up? So I've corrected that there. So the expected return, if the stock's at $90.20 at expiration, how much is your 90 call worth? Well, you can buy stock for 20 cents less than it's trading now. So it has 20 cents of intrinsic value at that point. You spend $3.75, so it only has about 5% of the value left. So you've lost about 95% of the value in that scenario. But if it does go up substantially, if it goes up 20%, then all of a sudden this thing is worth $8.40. And if you take something that started at 375 and you go up to 840, that's more than 100% return, 125% return. So our range in this scenario of this particular call is basically losing it still to being up 125%. We could also do a call spread. So we're expecting the stock to be in a range of $90.20 to $98.40. In which case, this 100 call would have no intrinsic value at expiration. If it has no intrinsic value at expiration, then we've sold something that became worthless. And that's always a great thing to do. If you're trading options and you can sell options that are expire at 0, then you're doing something right. And so let's look and see how this would affect our P&L if, in addition to buying the September 90 call, we sold the September 100 call and made it a call spread. So here's our options montage. There's the 90 strike. There's the 100 strike. We can see that the midpoint for this 90 strike call is around 375. Stayed the same. And for the 100 strike, it's looking around 170-ish. So we'll call it 170. And so now the combined position, if we are buying the 90 call and selling the 100 call in the September expiration, it's going to cost us around 205. The market says that the 90 call has a 36% chance of ending up in the money and that the 100 call has around a 20% chance, a 20 delta of ending up in the money. So what's our expected return? Well, in this scenario, when the stock's at $90.20, the 100 call is going to be worthless. The 90 call is going to have 20 cents of intrinsic value, and so the position is going to be worth 20 cents. So this shows a negative 90% return, but we also spent a lot less at around 205 instead of 375. So even though it's a large percentage return, we've still spent a lot less money, $205 per contract. How about if the stock goes up to the top of that 20% range at $98.40? Well, the 90 call is now worth $8.40, and that 100 call is still worth nothing. So since we brought the cost of the position down from 375 to 205, the return on the position that becomes worth $8.40 is now a 310% return instead of 125% return. So clearly we've done something good. I mean, we've shifted the max profitability way up. We've decreased the cost of our position substantially. What else could we do? What are the other choices for us? Well, we can sell a put. If stock's going to go up when you're selling a put, what you're saying is someone can sell you the stock at a certain price. Well, if you're selling in the at-the-money put, you can collect $5.90 about for doing that. And if the stock goes up, then no one's going to try to sell you a more expensive thing for less money. And so that's going to expire worthless. You're going to collect $5.90 on that position. Now, how do we want to track the return on that? Well, probably your brokerage is going to have you, it's going to say for your account, we need to keep about 20% of the value of the stock in reserve on the side in case the put moves down, because you're selling a put and they want some protection. They could ask you to keep 100% of the put's value, depending on what type of brokerage you're using and what kind of options trading you do. But they also, a lot of places would say 20%. So let's just imagine that they're going to hold 20% cash reserve against that position, and they might force you out of the position if it starts moving against you. But 20% of $8,200 would be around $1,640. So let's just imagine that it's kind of like you're putting $1,640 up for this position. You are going to make $590 if everything goes your way, and so you've made a 36% return on this position. So that's great. So there's no, if you're right about your assumptions, you're definitely going to make money. So that's a great thing to do. What else could we do? Well, all of these positions are just for a single expiration, but that's not the only way we could trade this. So our assumption is that this stock is going to go up steadily over time. If we thought it was going to jump up 10% overnight, then we wouldn't be most profitable to own an option 6 months out. We'd probably want to own the option that's 2 weeks out or a week out, because that option could go up 500% in value. But we think it's going to slowly increase in value over time. So if that's the case, we could still own an option 6 months out, but potentially we're saying it's going to get in the range of 90-ish to 98 over the course of 6 months, but what's it going to do 2-3 months from now? Well, if it goes up steadily, it probably won't get too high in that amount of time. So another choice available to us is to sell a call, sell the 90 call that's going to expire earlier that probably won't end up in the money, probably won't have value. And anytime we can sell options that we think won't have value by expiration, then we're doing something smart. Further, if we kept the 90 call, if we decided to sell a 90 call, say in June, and we owned the September 90 call in September, our brokerage is going to be pretty happy with us, because they're going to say, hey, look, you're giving someone the right to buy this stock at 90. But you have the right to buy the stock at 92. So it's not going to hurt you so much as long as you have that back month option, the long dated option in your pocket. The front month 90 call will never be worth more than the back month 90 call. They're both going to have the same amount of intrinsic value if stock goes above 90, but an option that's going to expire later will always have more premium, more time value. And so if you are selling an asset when you already own a more valuable asset, that's going to make your brokerage feel good. And so when you are selling different expirations, if you own the same strike and you own the longer dated one, they're going to treat that like it's a very safe, and they're not going to hold a bunch of margin. They're not going to make, they're not going to start making you borrow money to protect it or anything like that. Okay, so what is that June 90 option trading for? Well, let's say you're selling it. You're probably going to sell it a little below the midpoint. So we'll say 175 is how much you'll be able to sell it for. So if we own the September 90 call for 375 and we sold the front month option for 175, then the total cost would be about $2 for the position. So we brought down the cost of our position quite a bit. So now we own this June-September 90 call spread. It's a time spread between June and September for the 90 call. What does our P&L look like over time? Well, if we're right in the June 90 call expires worthless, then we've brought the total cost of our position down to $2. And at that point, the actual intrinsic value left will be just what the September 90 call is worth. It's going to be worth somewhere between 20 cents and $8.40. And that would give us a P&L in the range of losing most of the value, losing 90% of the value, up to gaining 320% of the value. So that's a new kind of spread, and it gives us a return that's a little bit similar, at least in this scenario, to what the 90-100 call spread would be worth. But what if things unfold a little differently than we're expecting? So we have an expectation that the stock's going to move between 10 and 20% over the next 6 months. What if it moves more than that? What if it moves 30% over the next 6 months? Then how do these two positions look? Well, all of a sudden, if the June option still expired out of the money, if the stock hadn't gone above 90 by June, all of a sudden we own the September 90 call free and clear. We collected $1.75 for selling that June option, but now we just own the September 90 call, quote unquote, naked. We just own it outright. That means that we now have the unlimited upside potential as stock goes higher and higher. And so if the stock goes up 30%, that would be to $106. All of a sudden, that option is worth $16. And it only cost us $2 to enter into the position. So we've made $14 on our $2 investments. That's a 700% return. Whereas the September 90-100 call spread, well, it's going to max out. The most that call spread can be worth at expiration is $10. Because that's the maximum difference in the intrinsic value, is you can buy the stock at $10 less, and someone's going to be able to buy it back from you $10 higher than that. So that could be worth $10, and it costs you $2.05 to get into it. So the position could get up to close to $8. That's still a great return, but you don't have the unlimited upside that you'd have if your front month option that you sold expires worthless, and then you own the back month option, the long dated option, outright. So that's the kind of rosy scenario where the time spread actually works a lot better than just a standard call spread. So now let's look at what happens if the stock jumps up in value. It goes up 30%, but it does it by the June expiration. Well, you're still long that 90 call in September, right? So this feels like a very positive move for you. But how does that actually affect our real P&L? So we're going to still have time left in these options. So we can't just say what the option is worth based solely on the intrinsic value. So we actually need an options calculator to tell us. So we're going to keep our volatility assumption around 31. So we're going to say there's not a change in vol. But we're going to say, okay, what happens if stock's worth $106 by June? And so we have to look at the individual options on their own. We can't just look at the intrinsic value. So the September 90 call in this scenario is worth $18. In the September 100 call, you still have 90 days left because it's only June, is worth $10.54. So it's interesting, that difference is $7.50. Even though they're both well into the money, you'd feel like maybe there should be a $10 difference in the value of these things. But what do we know about in the money options versus options that are closer to at the money? Well, the options that are closer to at the money are going to be the ones that are the most sensitive to move in the stock. They're going to have the most time value, the most premium, essentially the most optionability. Like what makes an option is the strongest when the option is at the money. There's the widest range of possibilities that could possibly occur. So the at the money is going to have more premium, more time value than an in the money option will. But when stock moved from 82 way up to 106, all of a sudden the 100 call is the option that's much closer to at the money. It's going to have more premium and more time value in it. And so even if you held this position all the way to expiration, that would be worth $10. Right now it's not, because that September 100 call has more time value in it. So that call spread would be worth $7.50, which is great. It's gone up from $205 to $7.50. And if you wait and stock doesn't drop down below 100, it's going to end up being worth $10 90 days from now. So you're going to you'll make $250 per contract in the next 90 days with that call spread. So it's kind of a refresher on some of the call spread topics that we talked about previously. So how does the time spread do? Okay, well, the September 90 call, as we've talked about, is worth $18.04. How much is the June 90 call worth at expiration? Well, that option's at expiration, so we know exactly what it's worth. It's worth the intrinsic value. And how much intrinsic value is in the 90 call if stock's trading at $106? Well, you can buy stock at $16 less than the market price. So you could buy stock at 90 and immediately turn around and sell it for 106 and make $16 per share. And so the June 90 call is worth $16. So our position total is worth $2.04. Well, what did we pay for it? We paid $2 for it. So we're long all these call options and the stock goes up 30%. We feel like we haven't made. And our position stays flat. And by the time you end up paying a little bid-ask spread and some commissions, you might actually lose money. Even though stock moved 30%, a huge move in your direction. But it did it too fast. The amount of premium left in your September 90 call decreased a lot, and the amount of intrinsic value in the one you sold went from $0 to $16. So if you are long a time spread, whether it's long calls or long put time spread, because you can do the same thing with puts, you want the stock to move in your direction, but you don't want it to move too fast, or you can actually manage to have a losing position by the time you exit out of it, or at least have no profits in it if it moves too fast in that direction. Okay, so if you went through this scenario and you said, okay, I didn't like that. I felt like I was going to have a big winner and I barely broke even. I sold an option that's too far out. I sold that June 90 call. I shouldn't have sold an option that had so much time to end up in the money. I should have just sold an option maybe 30 days out, because even though the stock moved up 30%, it didn't do it that fast, and I still would have not lost money had I sold an option 30 days out. And that's very valid. So if you sold an option 30 days out, maybe it didn't get up to 90 30 days out, and that option you're going to collect $2 or $1 for it instead of nearly twice that or more. But that's still a nice way to collect some money. You've collected an extra $105 on your position, and maybe that option won't become in the money, even in a good scenario of the stock moving in your direction. Okay, but what happens if you're successful? That front month option, that 90 strike, let's say stock ends up at 84, 86, that's going to expire worthless, but you still own the September 90 call. And what stops you from just doing it again? Because you still have that insurance program. You essentially sold an option to someone else that expired worthless. You know that you can't ever be hurt too much because you own the Backmonth option. You're not going to lose more than the difference in the two values of the options. But once that option expires, then you can just do it again. You have the same insurance policy in the Backmonth. And if you are successful, then potentially you could do this 5 or 6 times in a row before your September options come up. If you do this just right, even if the stock doesn't move, you could potentially collect $6.30 between now and September, even with the stock staying flat. And that Backmonth option costs you $3.75. So in that scenario, if you do this just right, you might be able to turn a profit on this calendar spread, this time spread, just from rolling that front month option. You sell it over and over and over. So what did we learn about the front month option? The front month option's value decays a lot faster than the back month's value option. So you are constantly selling a front month option, which is going to go to zero value within 30 days. But your back month option is not going to go to zero value. It's going to go down just a little bit, even if stock doesn't move. So you're selling something that fizzles out in the pan. And if you do it just right, you could potentially do that over and over and over and derive a really nice profit from this position, even if stock doesn't move. So all of a sudden, if you just break even on your 90 call, you can still make a ton of money and end up at $10 per share if you just break even, if stock gets up to $90 and $93.75. And even if it just goes sideways and you do this over and over, you can still make the difference between 630 and 375. Is that around 250, a little more? Even if stock doesn't move, and that'd be like a 70% return even if it didn't move. So let's look at it. So you get 630 from the short call. If the stock ends up at $90.20, you make 20 cents there. So you make $6.50 in that scenario. And if it goes all the way up to $98.40, then your position is now worth all the way up to $14.70. So now all of a sudden, your potential range of profitability is if you're right about this assumption and you're able to sell that front month option over and over and over, and they all expire worthless, which is a very rosy scenario, then potentially your profitable range here would be, you'd be guaranteed to make somewhere between 200 and 400% on this position. That's going to be hard to do in the real world. To sell something that's a little bit out of the money and have it expire worthless over and over and over is unlikely. What did that front month option, what was the delta on that front month option that we sold? It was around 20. That means that the market thinks there's about a 20% chance that it's going to end up in the money. And so if you do this 5 or 6 times, you should expect that one of them is going to be a loser. Could be 0, it could be 1, it could be 2. You could get really unlucky and it could be more than that. So batting 1,000 with these is unlikely unless you're selling an option that has like a 5 delta. If you're selling the 120 strike call on the front month, then yeah, the chance of that ending up in the money is almost none, but you're going to collect pennies. If you're selling options that are worth so little, as the traders I used to work with called it, they called that picking up nickels off of the train track. In this case, you'd have some insurance at least, so you wouldn't be selling it naked. Okay, so let's look at a rolling time spread. Let's look at something where you own the back month option 6 months out and you are selling the front month option about every 30 days. So let's look at that as a real example. Okay, so I just dug around until I found a stock that moved fairly steadily up over the course of around 180 days, around 6 months. And the ETFs are always going to be less volatile than the individual components. And so I just chose SPY for this example, and I chose a roughly 6-month time range where it moved up 18%. So if we did this strategy, if we sold a 30-day 20 delta option, meaning out of the money option, call it the same, or approximately the same strike as the back month option that we owned, what would we expect? Do you think you are going to 100% of the time be successful with that, or how's it going to look? So let's dive in. So I'm going to create a custom strategy. So at the bottom of the strategies list, there's something called custom. I'm going to click the add button. I'm going to enter a name. I'm not having any shares of stock in this scenario. I'm going to add 2 different options down here. First, I'm going to add a long. So I'm going to say direction long, call. I'm going to say 30 delta. And I'm saying 180 days to expiration. And the number of contracts is going to be 1. So I add that. And then I repeat. But this time I go short, call with 20 delta, because that was the 90 strike that we looked at was about 20 delta when it was a month out. I'm going to say 30 days to expiration. Then importantly, I'm going to uncheck the close all legs with front month. The reason is if this was checked, then as soon as this 30-day option expired, it would close the entire position and then it would reopen the entire position. When it reopened the entire position, it's going to say, I want to buy options 180 days out from May. So instead of looking at September options, it's going to be looking for October options. Now, there might not be October options, so you might end up with the same position the first month. But after 2 or 3 or 4 months, all of a sudden, you're going to be buying January options for the back month, and that's not what we're talking about right now. We want to own the back month the entire time, and we want to just roll the front month over and over and over. And so where it says close all legs of the front month, we're going to uncheck it. Okay, so then we let the simulator tell us what happens. So we have a great return. So stock moved up 18% and we made a 362% return. So that's fantastic. You know, that's the kind of returns that you hope for as an options trader. Generally, you place smaller bets and you're going to lose plenty of those bets. But sometimes you're going to be successful and you're going to make not 10 or 20 or 18% return, but you might make 200 or 300 or 400% return as you spread those returns out over time. So in this scenario, we got a 362% return, but did we win 100%? No. Right here, when we're opening the position, we're buying the 180-day call with a 30-ish delta, and we are selling a 30-day option with like a 20 delta. That's a pretty big run up right there. The stock, the SPY is going from 245 maybe up to 270 within 30 days. So that 20 delta option might have actually ended up in the money. So that might be one of our losers right there. Now, what we say is the red arrow indicates that we've closed part of the position. So we close that front month option, then we close it by buying it, and then we sell another 30-day option. Well, this looks better. We sold a 20 delta option, and this is a pretty gradual time period here. And so that's probably a winner for us when we close the position. And we can always click the tile and go and see all of the details. And then this is another time where it's like a relatively calm, nice upward movement. Maybe one of these ends up slightly in the money, but we still do well overall in the position. Here we're selling the 30-day option, and that's going straight down. So that's a great scenario for us because we still own the Backmonth option. But then here, when we roll it and sell it again, there's a huge run up. And so we're almost certainly going to lose on that. So we see that on some of the legs that we sold, we lost money on them. But overall, we did great in our position. And that's pretty typical of a rolling time spread. If you're selling an option that has some real value in it, you're going to lose some of them. But that's totally okay, especially if things are moving in the right direction in your Backmonth option. So that was a call time spread, but the put time spread calendars are the same. It's just that you want things to move down. And if you're selling the front month put, then you don't want them to move down too fast. Everything else is relatively similar. You want things to be relatively calm in the short term. And after your front month option expires, you want it to move a long ways in your direction. So everything that we just talked about is still true with the put time spreads, including that if there's an increase in implied volatility, your position is going to go up in value because that back month option is going to benefit more than the front month option. So you're still long vol. We are just going to talk very briefly about a short time spread. So if you are short a time spread, it means that you're selling the back month option without protection. So it means you might be short a long dated put, or you're short a long dated call. What makes it a time spread is that you're also buying a near-term option. If it's not a quote-unquote diagonal time spread, it means you bought the same strike. We'll talk about diagonal time spreads in the next class. But if you're buying the same strike, you're not hoping to make money off of that option you're buying. You're just getting some protection from your long-dated option that you sold. So the position is going to look a lot like just selling naked the back month options with a little bit of protection. And so if you're selling a long dated put short, you're saying someone can sell you the stock at that price. And so essentially you're going to want to be prepared to own the stock. And if you're selling a long dated call, then if you happen to own the stock already, then you're saying I'm okay to exit at that price. If you don't own the stock, you're saying I'm willing to be short the stock. But that's, for this class, that's as much as we're gonna say about those two things. In the next class, we're going to start getting into some multi-leg trades and some diagonal time spreads. And we're also going to look at, okay, if you own that straddle and it's whipping up and down, is there a way to make money from owning stock, from kind of hedging or adjusting your delta position as time goes? And there's some pretty interesting strategies around that. I'm going to do a quick summary. And then if there's any questions, I'll take them. And if not, then that'll be the end of this class. I'll look forward to seeing you in the next one. Okay. So when you're long a straddle, you're looking for the stock to move up or down, and you want it to move not just whipsaw back and forth, but you want it to move continuously in one direction. Initially, you don't care if it goes up or down, but after it starts moving a little bit up or a little bit down, you want it to continue moving in that direction. You want some real movement of the stock. And also, if the market thinks there's going to be movement, if there's expected movement and the implied volatility goes up, that helps your position as well. With a short straddle, you're hoping for calm. If the stock does move, you want it to bounce back and forth without moving a long ways in any direction. And if the market's assumptions about implied volatility, about the stock volatility decrease, then potentially you can exit the position early and take a profit. Additionally, if not too much happens, you can probably take a profit in the near term, because every day that position is going up in value, that stock doesn't move because you have sold options that are going down in value every day. So you can buy them back if nothing much happens at a profit. When you are long a strangle, it's a lot like being long a straddle, except stock has to move more in order for you to make some money. The initial cost is lower than if you bought a straddle. If the volatility assumptions in the market increase, that still helps you. And your break-evens will be a little bit further away, and so will your chances of turning a profit. If you're short a straddle, you want calm, and you want people to expect calm in the market. But you do have a range where the stock can move and still be at your maximum profitability. For that reason, your chances of having some amount of profit are also higher, but the best case scenario isn't as good as the best case scenario if you sell a straddle, because what you're selling isn't as expensive. With a long time spread, if you're long the call time spread, then it's still long-term a bullish position, but you want the stock to move in your direction after the front month option expires. If you're rolling that front month option a lot, then you're okay with relatively flat movement. Stock doesn't really need to move in your direction. You don't want it to move a long ways against you. But if stock kind of goes sideways, you could potentially sell that front month option over and over and over, and its time value is going to plummet. Each month it's going to go to 0, but that back month option is only going to slowly decrease in value, and so you can actually turn a nice profit that way if things go right. An increase in volatility assumptions will still increase the value because that longer dated option is going to have more time value in it. If you're short a call time spread, then as we talked, you're selling a long dated call. When you're selling a long dated call, if that doesn't work out in your favor long term, you're saying, I'm willing to be short the stock. If you're selling a long dated put, you're saying, I'm willing to buy the stock. So the short call time spread is neutral to bearish, and the short put time spread is neutral to bullish, because if the stock goes up, then you are not going to have to buy the stock at a lower price. In that scenario, the increase in implied volatility will have a negative impact on your position, because what you're short, if you want to exit out of that position, then the position that the option that you're short is going to be more expensive, and you're going to be forced to be in it. So near term, you're going to show a negative P&L. If you hold it to the end, then the real P&L will just be the intrinsic value. Okay, so in the next class, we're going to talk a little bit about gamma, a little bit about theta. We're going to talk about using stock to balance out the delta in your position. And we're going to talk about some of the cool strategies that Ophir has built and tested that are in the Today tab and in TradeMachine that use some diagonals. They're powerful strategies for managing the time loss for you, managing your theta. And we're going to get into that next time around. Thanks very much for attending today. Okay, I do see one question from John, and John says, yeah, how would you think about owning a long call time spread versus selling the short put time spread? Yeah, so ultimately it's a decision about buying options versus selling options. They both directionally want the same thing. When you're long that call time spread, if I'm buying long dated options, then when I'm looking at the market, I'm saying that I think the back month options are relatively cheap. I still want to finance that 6-month out call or my long dated call by selling an option front month. And I don't have an immediate opinion. I don't feel like the stock's going to skyrocket overnight. I think it's going to slowly move in that direction over time. But I think that there's substantial upside potential in the long run. I don't think that the stock's just going to like be neutral or just go a teeny bit up, because that'll be a hard way to make money if I'm just entering into the calendar as my one trade and not trying to roll it. So if I'm buying the call time spread, I'm saying I think the volatility looks affordable. I think that the stock's going to move more than the amount that the market says it's going to be worth. And I'm going to buy that backdated option because I think there's real long-term big potential to the upside. If I am going to sell puts or sell a put time spread, then what I'm saying is, in my mind, the way I think about it is I'm willing to own this stock. I'm selling puts short. I feel like it's a perfectly reasonable stock to own. I don't think there's much downside risk. I think that this stock is trading pretty close to some kind of multiple of book value that I'm comfortable with. I just think that their customer base is solid. I feel like the revenues are solid. Like, I don't feel like the stock has much further to go. Additionally, it could have been a volatile time. If I'm trying to sell options, then I want to sell options when options are expensive and when we've gotten through the worst of the volatility. So the best time to sell puts is after the market plummets, where the volatility is sky high, where the options are extremely expensive, but where there's actually not any more downward movement. So if you look at the COVID crash, whenever it was in like April, all the options are still really expensive. If you chose right then to sell puts, that'd be great. The market's going to go up and those puts are going to expire worthless, but they're going to be expensive puts. So if I'm selling long dated options, I'm saying to the market, look, I think the market thinks that there's more volatility and more risk than I do. What I'm selling a put in, I feel like is a solid thing to invest in. And if I'm doing that as a time spread, then maybe I'm saying like, I could be wrong. This thing could go down more right away. So as the market's crashing, maybe I'm not sure I've timed the bottom perfectly, and I don't want to take the risk on this thing going down another 30%. So I'm going to go ahead and buy a little protection 30 days out because I'm trying to hit the bottom. I'm trying to sell this put spread, and I'm trying to time the bottom of the market, but I don't feel that confident. I don't know if it's going to bottom now or it's going to bottom in a month. So I'm going to go ahead and buy a little protection. I'm going to buy the front month call. I'm going to buy the front month put to have some downside protection, but I'm going to sell that back month put because I think long term we're going to be way over this in the long term. That's kind of some thoughts. There are lots of different ways to look at this. Okay, everyone. Thank you so much for joining today. We're going to talk about some really great topics next time around. It will be in 3 weeks on Thursday at the same time. Thanks for being a member. Thanks for being part of our community and for being part of TradeMachine. And I'll look forward to seeing you all in 3 weeks. Thanks very much.